Hello, all of you have heard of scheduled banks. So, in this session, we'll understand what are scheduled banks. Scheduled banks are those banks whose name is included in the second schedule of Reserve Bank of India Act 1934. Any bank whose name appears in the second schedule of Reserve Bank of India Act is a scheduled bank. Any bank whose name does not feature in this second schedule is a non-scheduled bank. So RBI Act also stipulates the criteria which need to be met by a bank to become a scheduled bank. Let us see what are the criteria that a bank needs to meet before it qualifies to become a scheduled bank and it can get its name included in the second schedule of Reserve Bank of India Act. There are primarily two conditions which should be met. The first is that its paid up capital and reserves should not be less than rupees 5 lakhs. Paid up capital and reserves should not be less than rupees 5 lakhs. This is the first condition. The second condition is that it must conduct its affairs in a manner which is not detrimental to the interest of its depositors. The depositors are the principal providers of funds to banks. They have trust in the banking system. They place their hard earned savings in banks. So it is therefore incumbent on banks to protect the interest of its depositors. So RBI verifies one, whether the bank has paid up capital and reserves of not less than rupees 5 lakhs, and two, that it is conducting its affairs in a manner which is not detrimental to the interest of the depositors. The question is, how does RBI verify whether the interest of the depositors is being protected by the bank or not? So RBI conducts inspections annually. They're called annual financial inspections. These are in the nature of on-site inspections. A team of RBI officials lands up at the bank at its corporate office or its branches and verifies whether the activities and business of the bank are such that the interest of the depositor is being protected or not. So, in addition to these annual on-site inspections, RBI also has off-site monitoring process in between two annual inspections. So, there are annual inspections, and in between two annual inspections, there is also off-site monitoring to review and assess the activities and financial condition of the bank. So, what are the parameters on which the functioning and financial condition of a bank is measured? It is done using a model called CAMELS rating system. CAMELS is an acronym which stands for capital adequacy, asset quality, management, earnings, liquidity, and systems and controls. So let us see all of these separately. So RBI first looks at the capital adequacy of the bank. So capital adequacy is something that we'll understand in detail later in a subsequent session. But today it is enough if you understand that a bank must have adequate capital to absorb any losses that may arise out of the business of banking. In the previous session, we saw that banks perform the function of risk management. They handle risk. Now, any losses that may arise out of these business should be absorbed out of the capital of the bank, and it must have adequate capital to absorb losses arising from the business of banking. The second criteria on which a bank is evaluated is asset quality. The main assets of a bank are loans. The borrowers are debtors of a bank. So assets can be of two types, good assets and bad assets. In banking terms, good assets are referred to as standard assets. Bad assets are nothing but non-performing assets or NPAs, which are equivalent to bad and doubtful debts in accounting. So bank must have a high proportion of standard assets and low NPAs in its total portfolio of assets. This is the second criteria. The third criteria is the management. Is the management capable and competent to handle the complex business of banking? Can they accept and meet the challenges that may emerge in the business of banking? This is the third criteria. The fourth criteria is earnings. Every business needs to have earnings to stay viable. The viability of a business depends on its earnings. So, as we saw in the previous session, the main earnings of a bank is its interest spread. So, does it have a good interest spread to stay viable and sustain in the business of banking? So, earnings are scrutinized by the RBI audit and inspection team. The next criteria is liquidity. A portion of the deposits that are placed in banks are in the nature of demand deposits, which means they can be current account balances or savings banks where the depositor may at any time want the money back and withdraw it to the bank. In such a situation, the bank must have adequate liquidity to meet the demand of a depositor at any time. So liquidity is also a parameter which is assessed by the RBI inspection team. Finally, the team looks at systems and controls. Does the bank have a robust system to manage and mitigate operational risk arising out of its business? So essentially, the RBI team does what is called a risk focused supervision, and it satisfies itself that the bank has a stable position and the interest of the depositors will not be jeopardized or endangered by the activities conducted by the bank. So Camel's model is used for Indian banks. For foreign banks, there is a slightly different model that is used by the RBI inspection team. There is one change, it is compliance. So it is referred to as CALCS, which means capital adequacy, asset quality, liquidity, compliance, systems, and controls. So it's important for a foreign bank to comply with Indian laws and regulations relating to the business of banking. The foreign bank must comply with the provisions of the Indian Companies Act, Banking Regulations Act, RBI Act, among other acts, and that is verified on an ongoing basis by the RBI inspection team. So for foreign banks, the model is CALCS. For Indian banks, it is called the Campbell's model of rating. Now, what are the privileges enjoyed by a scheduled bank? A scheduled bank enjoys two major privileges. First, it can borrow or lend to RBI, borrow from or lend to RBI at bank rate. So this is part of the treasury function of a bank. If the bank has surplus funds which it cannot deploy in loans or investments immediately, then until such time it can lend to RBI at bank rate. So lending to RBI is completely safe. There is absolutely no risk of default, and the bank is assured of a return at bank rate which is currently 4.65%. On the other hand, if a bank is having a shortfall of funds, it wants to tide over its liquidity problems, then it can borrow from RBI at bank rate. So the bank is assured of a line of credit in case it has some liquidity crunch. The second privilege that a scheduled bank enjoys is that it automatically becomes a member of a clearing house. A clearinghouse is an organization where checks are exchanged for settlement of funds between different accounts maintained with different banks. So these are the two privileges that a scheduled bank enjoys. There is also an obligation on a scheduled bank to maintain reserves in the form of cash reserve ratio. So, a scheduled bank must keep with RBI reserves in cash to the extent of 3% of its demand and time liabilities in India. The total of its demand and time liabilities in India have to be considered while calculating the cash reserve ratio. Demand liabilities are primarily the demand deposits of banks, which means current accounts and savings accounts. Time liabilities are mainly term and recurring deposits that are held by banks of its customers. So, if the aggregate of demand and time liabilities of a bank is say 100, then it must keep with RBI an amount equal to 3 rupees in cash as cash reserve ratio. This is a requirement also for non-scheduled banks. However, non-scheduled banks are not required to keep this reserve with RBI. They can maintain it with themselves. Scheduled banks are required to maintain this reserve in cash with Reserve Bank of India. So as you've seen, there is an advantage of keeping our deposits with scheduled banks. The reason is that one, in case the scheduled bank has some problem of cash, they can always borrow from RBI. They have a committed line of credit from where they can borrow from RBI. More importantly, the activities, operations, and business of a scheduled bank is annually verified by an RBI team, and they periodically satisfy themselves that the bank is conducting its business such that the interest of the depositors is protected. And if they find any discrepancies or irregularities, they ask the bank to initiate corrective actions. To that extent, it is always better to deal and to place our savings with scheduled banks. So, this is our session on scheduled banks. Thank you for watching.